Today, we're cracking open the book on the art of value investing to figure out how the absolute best investors in the world consistently come out on top.
So you look at the market, right? It's just a whirlwind of noise. Predictions everywhere, new strategies popping up every day. But what if I told you there's one core idea, a single philosophy that has guided legends like Warren Buffett for decades? Yeah, it's not about jumping on the latest trend or getting some secret hot tip. It's about a completely different way of thinking.
So what is this big idea? Well, it all goes back to the OG, the father of value investing, Benjamin Graham. And really, it boils down to two simple but powerful pillars that, honestly, will completely change the way you look at the stock market.
Okay, so the very first thing you do, you got to learn to tune out all that daily noise. The stock price jumping up and down, forget about it. Your job is to figure out what the business itself is actually worth. Its intrinsic value. So you're digging into its assets, its debt, what it's likely to earn down the road, all to get to a solid conservative number. Think of it like this. As investor Will Brown said, you're trying to figure out what a smart buyer would pay to own the entire company, lock, stock, and barrel.
And that brings us to maybe the most important concept of all, the margin of safety. So once you've got your number for what the company is worth, you don't just go out and buy it. No way. You wait, and you only pull the trigger when the market is selling it for way less than that value. That gap, that discount, that's your margin of safety. It's your buffer against being wrong or just bad luck. Because let's face it, as the great investor Jean-Marie Eviard put it, the future is uncertain.
And this just perfectly sums up the whole mindset. The late, great Charlie Munger. He didn't see value investing as some style you pick from a menu. For him, it was just sensible investing, period. I mean, the logic is so simple, right? Figure out what something's worth and then try not to pay too much for it. That's it.
Okay, but this is where people get tripped up, right? You hear value investing and you think, oh, so you just buy cheap, junky companies that are in the bargain bin for a reason? Well, you might be surprised to hear that the answer, especially as the philosophy has grown up, is a big, fat no.
See, in the early days, it was a little different. Warren Buffett had this great analogy. He called it cigar butt investing. The idea was you'd find a soggy, discarded cigar butt on the ground that had one good puff left in it. It's kind of gross, but the point is you get that one puff for free. So you'd buy these mediocre, even terrible companies just because their assets were dirt cheap. But that's not the game anymore. The modern approach, thanks to guys like Buffett and Munger, is all about finding wonderful companies, but at a fair price.
And this brings us to another massive, massive misconception in the investing world. This idea that it's some kind of battle, that you have to pick a team. Are you team value or are you team growth? But the pros, they'll tell you that's completely the wrong question to be asking.
Here's the mind shift you need to make. Growth isn't the opposite of value. It's a part of value. As investor Bill Nygren points out, they're not two different things. Think about it. A company's ability to grow in the future, well, that's a huge piece of what it's worth right now. The real question is never, is it a growth stock or a value stock? The real question is, how much am I paying for that growth? And all of this, it's leading up to what might be the single most important secret of value investing. And it's not a complex formula. It's not a whiz-bang spreadsheet. It's your mindset. It's all about temperament. It's about psychology, not calculus. It starts right here, with what the legendary Seth Klarman is saying. It's about having the guts, the psychological steel, to stand apart from the herd, to be the one buying when everyone else is screaming sell, and to be the one asking tough questions when everyone else is at the party. I mean, it sounds so easy on paper, doesn't it? But trust me, in the real world, it's one of the hardest things you'll ever have to do. So really, success comes down to these core traits. You need humility, the ability to just admit you don't know what the future holds. You need incredible patience. I'm talking about the willingness to just sit on your hands and do nothing until the perfect pitch comes along. You need discipline, the kind that makes you stick to your plan even when it feels like it's not working. And you need a healthy dose of skepticism, especially when everyone agrees on something.
And here's another absolute classic from Charlie Munger. He's saying the secret isn't about being super intelligent. It's not about being a genius. The real advantage comes from just consistently not being stupid. It's about having a good system and the emotional control to avoid those huge, obvious gut reaction mistakes that wipe so many people out.
Okay, so we've gone through all this, but what does it actually mean for you? How does this apply to your own approach?
You might be thinking there's some big secret here, some formula locked away in a vault. But as Seth Klarman says, there is no secret. None of this is new. It's been out in the open for almost 100 years, ever since Benjamin Graham first wrote it down. The whole playbook is right there for anyone to read.
So, if everyone knows the secret, why does it still work so well? The answer is simple, because it's hard to do. It's painful. It hurts to buy a stock that all your friends are making fun of. It's agonizing to sit on the sidelines while some hot new thing is doubling every week. The reason the strategy keeps working, as Joel Greenblatt says, is because most people just can't stomach the emotional roller coaster. They don't have the discipline to see it through.
And that's really the big promise here, isn't it? Let's be clear. This is not a get-rich-quick plan. It is a marathon, not a sprint. The whole philosophy is built on one thing first. Don't lose money. Protect what you have. And then you can focus on growing it, steadily, patiently, and yeah, slowly, over a long, long time.
So in the end, the most important question you have to ask yourself has nothing to do with spreadsheets or financial models. It comes down to who you are, deep down. It's about your personality. Are you a natural-born bargain hunter? Do you get a genuine visceral thrill from finding a fantastic deal? Because if you do, then you might just have the most important tool you need, that instinct. That's the real heart of the arc of value investing.